China's stock market rally in 2024 has been incredible, as the CSI 300 index jumped over 20% in September. Also, the Shanghai Composite Index rose an impressive 15.82% from the beginning of September to the end of October. In this video, we'll look at the top 3 insights you must know about the Chinese stock market so that you don't miss out on the rally. Firstly, we'll find out what drove the rally. Then we'll look into if Chinese stocks are still undervalued. And in the last part, we'll look at the main bullish and bearish factors to consider with investing in the Chinese stock market. So what drove the rally? The rally's incredible speed and scale caught investors' attention globally, which has renewed interest in the Chinese stock market. Despite the popular indices such as the CSI 300 and Shanghai Composite pulling back in October 2024, the Chinese stock market remains hot under investors' eyes. But how exactly did it start? To find out, let's look back at the negative sentiment caused mainly by the real estate sector. The Chinese property sector is still damaged following the collapse of the Evergrande Group in 2021. Excess liquidity, along with great expectations for real estate market appreciation, led to a significant increase in speculative capital. It's essential to bear the real estate crisis in mind because it helped lead the Chinese government to introduce aggressive policy changes to stimulate the economy. Such changes include lowering short-term market interest rates on mortgages, which should help ease real estate market concerns. The government said the mortgage rate cut should help Chinese households save over $21 billion per year. Another key stimulator is that the People's Bank of China announced a 50 basis point cut in the reserve ratio, which works out how much cash a bank needs to keep free. The government reduced the reserve ratio from 10 to 9.5%, which should allow banks to have more free cash to drive economic growth. According to China's central bank, the basis point cut should help boost liquidity by $142 billion. Xi Jinping wants to double down on his efforts to build a stronger stock market as he's looking to raise shareholder returns. The Chinese State Council has 9 measures to get companies to boost dividends and investment values by increasing their control of payouts. More loan facilities were introduced to boost share buybacks through a new program to make it easier for brokers and insurers to buy shares. Furthermore, the People's Bank of China is allowing companies to take out loans through commercial banks at only 2.25% to boost share buybacks. Additionally, the government has introduced initiatives such as the 500 billion yuan swap facility, which aims to help boost liquidity and restore confidence among investors. The government has promised over $112 billion for the schemes to help pump up the markets. Furthermore, fiscal pledges to boost government spending have fueled optimism in China's commitment to hitting its economic growth targets. The broad stimulus package has lifted the stock market, although doubts remain about it long term. In the next part, we'll look at if Chinese stocks are still undervalued. The dramatic turnaround in China's stock market has led to an investor frenzy, especially among domestic traders. Over the last few months, Chinese brokers have seen unprecedented trading activity, with many struggling to handle the sheer volume of new accounts being opened. Stock investing has historically been less popular in China compared to other major economies. This sudden influx of new trading activity suggests a potential cultural shift in how Chinese households allocate their wealth. However, the surge in enthusiasm has raised questions about whether it's driven by fundamentals or simply speculative excitement tied to government intervention. During the recent rally, there are concerns about the economy's underlying health. The property market remains fragile as new home sales fell by 27% year over year in August. Also, high youth unemployment and slowing consumer demand signal that China's economic rebound may not be as robust as the stock market rally suggests. Investing in Chinese stocks come with unique geopolitical and regulatory risks. The Chinese government's heavy-handed approach to managing its economy and stock market has historically created unpredictable swings in company valuations. Crackdowns on tech giants like Alibaba, which lost over 80% of its value following government-imposed antitrust fines, are a reminder of how swiftly Chinese policies can impact major businesses. Additionally, foreign investors face the challenge of complex legal structures, such as owning Chinese stocks through American Depository Receipts or ADRs. An ADR doesn't directly represent shares in the company, but rather in an offshore holding of the company. U.S. policies also pose risks, with the potential for further trade tariffs and restrictions on investment in Chinese companies as tensions between the countries rise. These factors contribute to the cheap valuations of Chinese stocks now, but you must consider the high volatility that investors must navigate in this market. While China's economic growth potential remains significant, the risks make it a complex environment for long-term investment. In 1978, leader Deng Xiaoping began major reforms that helped the economy grow by over 9% annually. However, the MSCI China Index has only grown 4.4%. So why is this the case? The growth in economic development is not closely related to stock market returns, as Chinese households invest far more in real estate compared to stocks. In fact, only around 10% of household wealth is in stocks compared to around 60% in real estate. However, Xi Jinping wants to change this narrative by providing central banks with cheap funding to give companies a better chance to increase returns for shareholders. Chinese firms hit all-time high free cash flow levels last year by hitting 18 trillion yuan or $2.53 trillion according to Goldman Sachs. Higher shareholder returns would cycle back to the state owners, which account for 48% of Chinese equity market value. The crash in real estate prices and wealth management products caused a large sum of money ready to be invested elsewhere. However, if investors are going to allocate money to the stock market, there are concerns about how regulatory power and political intervention. Bullish and bearish factors to consider. The sentiment toward investing in Chinese stocks became negative following the regulatory impacts in recent years, most notably after Alibaba's case in 2021. The State Administration for Market Regulation announced a $2.8 billion fine for Alibaba for behaving like a monopoly. However, the Chinese government wants capital to flow into their businesses by trying to boost shareholder returns. It's obvious by the scale of stimulus measures that this is the case, particularly as we see an extremely low interest rate of only 2.25% for companies to take out loans for stock buybacks. The narrative from many Western media companies claiming the Chinese government is not trying to increase shareholder returns is not true. Luckily for Alibaba, the fine only amounted to 4% of their sales in 2019, so the company managed to recover quickly. Despite concerns about potential regulatory crackdowns, Alibaba has seen a sharp rise of over 30% since the beginning of 2024, while maintaining a PE ratio under 30. Additionally, in September of 2024, Alibaba announced it would be collaborating with NVIDIA on artificial intelligence that will enable Chinese automakers to develop autonomous driving. Famous investors such as Michael Burry have jumped into buying Alibaba, which is currently in the largest position in his fund's portfolio. According to his company's 13F filing, Scion Asset Management has a little over 20% of the portfolio in Alibaba. Additionally, he owns slightly more than 10% of his portfolio in other Chinese tech giants such as Baidu and JD.com. This means his portfolio has little more than 45% of its holdings in large-cap Chinese companies. A reason for his bullish view comes from the trailing 12-month PE ratio for the companies, which are as follows: Alibaba at 26, JD.com at 15, and Baidu at 12. These figures are significantly lower than the S&P 500 PE ratio, which is currently 29. Furthermore, large-cap U.S. tech companies such as NVIDIA have now hit 65 and Apple is at 35. He's clearly not seeing as much value in large-cap Western companies compared to the Chinese counterparts. Another high-profile name in the hedge fund space is David Tepper with a net worth of over $20 billion. Recently, he went on CNBC and stated that his fund is very positive toward Chinese stocks by clearly stating that he's bullish on everything, multiple times over. Despite the recent rise, China's major stocks such as Alibaba, Baidu, and JD still look relatively cheap compared to the amounts they are earning. One could argue they have moved from being very cheap to just being regular cheap. There could be further mortgage interest rate reductions or additional government spending that directly impacts economic growth. The policies the government introduced are designed to pump up liquidity, boost household spending, and ease credit restrictions for companies. Many large-cap Chinese companies look likely to maintain double-digit growth rates as they continue to show strong fundamentals. For example, Alibaba has a substantial cash position that accounts for nearly 50% of its market cap, contributing to a low enterprise value-to-cash flow ratio. As U.S. equities reach what some investors consider overvalued levels, many are looking to allocate capital to other markets. China's stock market has become a focal point for international investors. The valuation gap between U.S. and Chinese equities is considerable, leading to an anticipated rebalancing of global capital flows toward Chinese markets. The positive sentiment is reinforced by funds such as Michael Burry's Scion Asset Management, which has significant long positions in Chinese stocks. Similar rebounds have been seen in the past, but this one comes up with its own unique risks and opportunities which you have to weigh up. You must do your own research before buying any stock, especially if it's a company in a different country or industry you're unfamiliar with. Check out this video for more tips on how to find large gains from stocks, according to Warren Buffett. Also, please consider subscribing and clicking that like button because it helps. Cheers!